Okay, so today we are doing APR for dummies, and I'm the dummy. Well, I used to be the dummy because every time I saw APR on a loan estimate, my brain was like, what is this? Is this the rate? Is this the payment? Like, what is this? Is this a new boy band? Like, what is it? So today I want to make APR make sense in plain English so you can compare loans without feeling like you need a finance degree. Quick note, I am not a lender. Always confirm numbers with your loan officer. I'm just here to help you understand what you're looking at so you can ask better questions. So, what is APR? APR stands for annual percentage rate, and here's the simplest way to think about it. Your interest rate is the cost to borrow the money. APR is the interest rate plus certain loan costs rolled into one number so you can see the truer cost of the loan over time. So yes, APR is usually higher than the interest rate because it includes fees. APR is basically the loan saying, hey bestie, this is what we're really paying for when we include some of the extra stuff. What APR includes and what it doesn't. APR can include certain costs like origination fees, which are the lender fees, some closing costs, and discount points if you pay points to buy down your rate. But here's what surprises people the most. APR does not include everything. For example, APR typically does not factor in things like property taxes, homeowners insurance, and any appraisal fees. So APR is helpful, but it's not your entire monthly payment story. APR versus interest rate. The dummy or Jenna example. So let's do a super simple example. Loan A says the interest rate is 6.5%, but the APR is 6.9%. Loan B says interest rate is 6.6% and the APR is 6.7%. Now, the dummy version of me would go, loan A has the lower rate. Duh. No. But APR is telling me that loan A may have more fees backed into it, so the overall cost could be actually higher. So when you're comparing loans, APR helps you compare apples to apples, especially when the fees are different. When APR matters most and when it doesn't. APR matters most when you're comparing similar loan types and terms, like a 30-year fix versus another 30-year fix loan. You want a clearer picture of the long-term costs. Two lenders are offering the same rates but different fee structures. APR matters less when you're not planning to keep the loan long. Like you might sell or refinance soon because the APR assumes that you're going to keep the loan for the full term. So it may not match your entire real life plan. Also, your credit score can impact interest rates and your fees. Stronger credit means better pricing, which can lower the APR. If you're even a few months out from buying something, sometimes small moves like paying down balances or correcting errors can really help your options. The big takeaway and what to ask your lender. Here's the takeaway. Interest rate helps you understand payment affordability. APR helps you understand the bigger cost picture, especially when fees are involved. If you're shopping loans, ask this: what fees are included in the APR? If I plan to keep this loan for X amount of years, which option is better? Is the rate lower because I'm paying costs, or is it lower because I'm paying points? If you want more information, like a simple guide, just comment below APR and I will send you a checklist of what to look for when comparing loan estimates. And if you are buying and selling in Las Vegas or Henderson and want a real world game plan, geez, tongue twisters over here, message me and I'll help you connect the dots without the confusion. Okay, Jenna lesson complete. I hope you guys enjoyed. Until next time, I'm out.